All right, welcome investors from the Emerald City of Seattle. I'm here once again with the Grassroots Portfolio Manager, CEO, and founder of TappAlpha, Katara. Sai built TappAlpha on a scrappy can-do entrepreneurial attitude from nothing. Using an unconventional background as an engineer, navigated the complexities of the finance industry to bring to market TSPY, the first zero DTE covered call ETF that trades with real shares, tracking the S&P 500 with a blend of not just income, but growth as well. So, Sai, welcome back to the channel for the third time. How you feeling?
Jordan, it's great to be back with you, and it's such a treat to actually have you in my hometown of Seattle, Washington, sitting outside instead of stuck behind a screen having a conversation in person.
Well, that's right. I mean, I think what people are most used to is webinars with suits and ties, collars as well. In office spaces with boring backgrounds. So here we want to give you guys an interesting backdrop for a conversation with, just a really entrepreneurial person like Sai here. The occasion is marked by the 1-year anniversary of TSPY. We want to kind of unpack some of the lessons learned in Sai's journey with operating TSPY. But first, Sai, let's kind of rewind the clock a bit to know, how does someone like yourself go from a background in engineering to wanting to create an ETF company from the ground up with just yourself when you were previously running a pretty successful business? You're in it for a long time. Can you maybe just shed some light on that before we get to the lessons learned in regards to TSPY?
Yeah, appreciate it. I think necessity is the mother of all invention. So the story that got me here, it's been a really, really amazing journey, but one that I think is probably unconventional when it comes to ETF management, ETF issuer space. So I came from a technology background, computer engineer by trade, worked at a startup in Silicon Valley that got bought by a big company called Cisco. And then in 2005, I was lucky enough to have a little bit of breathing room to start my very first technology company. Built that, ran it for 17 years, and then sort of in October of 22, sort of had this moment. You look back at your life and your career, and you think, if I don't make a change, I'm going to be here for another 17 years. And I think the thing that really brought home that moment to me was we were having our first baby girl coming 4 months from that time. And that really puts things into focus. And so I thought to myself, look, what kind of impact do I want to have, and what kind of role model do I want to be for my little girl? And ultimately, what sort of fingerprints do I want to put on the world, and is this it? And I decided to make the tough choice of saying, no, let's try something different. I didn't exactly know what that different path was going to be, but I knew I loved finance. I just didn't know exactly what that was going to amount to. Well, if you remember October of 2022, the markets were way down.
Oh, I remember.
And I think a lot of us felt it, and I was always sort of an S&P 500 buy and hold investor. I didn't want to have to sell shares in order to make ends meet. So I remembered a strategy my dad had taught me, which was covered calls. He was an engineer turned advisor as well. But the novel thing that happened, serendipitously right at that same quarter, was short-dated covered calls just became available, so they'd expired every day. And as an engineer, that appealed to me because of the precision of being able to use zero-dated covered calls. I wanted to try it and see if it amounted to anything. Well, fast forward 2 months, and just the option premiums on top of my SPY shares was covering the lion's share of our family's mortgage, which for us at that time, having our first baby, was a game changer. And it was one of those things, you have those moments where you kind of look around, and I felt so grateful for it, because the first year of my daughter's life, I was there. I didn't miss a thing, and I didn't have that financial stress on my shoulders because of the strategy. The challenge was, it took so much time. If I was working full time, no way I could have done it. It took 3 or 4 hours a day. So with the technology background, I ended up building some cloud-based tools that took 4 hours of work down to under 5 minutes. And that for me was the aha moment where I said, wait a minute, if this is impacting our lives so positively, how can I actually build something for the world where I can help other families like ours? And the other part of it was kind of this realization, I was really lucky, because I had the technology background, and I had parents. My dad had taught me about options and financial markets, and my mom also the same way, but not everybody has that. And that was the overall idea of wait, how do you provide access to financial opportunity for everybody? where not everybody maybe is as lucky or has the opportunity to get the education or the capability to do it. And so that was really the whole idea about TappAlpha and the company. How do you help people tap into the potential they already have? And that's exactly what we did with our SPY shares, and that's essentially what we built with TSPY. There was no product on the market that did that. And we ended up being one of the earliest ones to get out there, one of the only ones that actually uses real shares to go and actually take the growth capabilities of the S&P 500 and add this little income generating engine that actually amounts to some meaningful cash flow for families that need it.
Nice. Well, let's talk maybe a little bit about TSPY and just what makes it kind of unique. From a personal standpoint, when I first found your product, and I immediately had to reach out because for my audience and those who have been on with my journey, with watching my YouTube videos on a regular basis, many of you know that I am not just income heavy, but I am interested in the capital appreciation from the unit price appreciation. So I often say I am yield seeking, growth leaning.
Love it.
So from that perspective, when I saw the name of TSPY and the fact that it had income and growth right in the title, I knew I had to talk to you about it, and that's led to a flourishing relationship where we kind of keep coming back around to talk about TappAlpha, TSPY, and what potentially comes next, of course. Now with TSPY turning 1, it's had some remarkable stable distributions, especially in the States. Up in Canada, we're pretty used to very stable distributions. That's not really the American cover call ETF landscape. It's kind of dotted with more variable distributions. But I can tell you this, at least for the people that talk to me up in Canada, they want stable distributions. They want something that's predictable. TSPY is delivering that here in the U.S. Modest fluctuation, ever so small. Anyways, can you speak about maybe the importance of that, lessons learned along the way with operating TSPY, and then after that we'll talk about kind of where you go next.
Yeah, I think it's really been an amazing education too, because what this has opened me up to is more conversations with other investors that are like-minded. And I really have started to learn what people care about, what they need, and really, like, as an engineer, recovering engineer, what problems people are trying to solve. And you sort of said it, like, if you have a long time horizon, you can't sacrifice all your growth in exchange for income now, because what does that do for your future? But now you still have needs from an income perspective, so how do you find a balance between that? And it took lots of conversations for us to figure what that is, and it also actually really fits the scenario of my family and what we needed, because we wanted that nest egg to grow. We just had cash flow supplements that we also needed along the way. And to your point about steady income distributions, like, how do you plan your life if you can't count on some of the things that you're leveraging? Now, as an ETF issuer, you can't guarantee any level of income distribution. Markets go up and down, but we do our best to pad it to make sure that we can sort of deliver what we were able to deliver over our first year. And so I think the first lesson that I learned was just, this has been an unbelievable platform for me to connect with other people that are like-minded to try and create something that this group of humans actually need, that it can benefit their lives. That's the most rewarding and energizing thing about it. And then you get on the other side of the lessons learned, where you understand the markets side. And markets are unforgiving, and they're going to do what they're going to do, and they're not predictable. And so, like, that's one of the core things that we learned. Like, we're not predicting anything. We're just managing risk. And so that's where we sort of built and have continued every day to improve the tool sets that we have that help us manage risk. One of the best ways to do that is to get lots and lots of valuable data and information, but find the signals in that. Otherwise, what would be noise? So we really invested in our underlying fintech that helps us sort of manage the risk that we see in the markets every day. And then one of the things I had learned, in April of this year, was that there's theory and then there's practice. In theory, markets should never do what sometimes that they do. And if you remember April of this year, when there were announcements from the U.S. administration, the market went down a significant amount, and then 7 days later the market shot up. a terrific amount. And so how do you manage that kind of what they call tail risk, when in theory it should never happen, but you learn in practice when you're risking real assets, they absolutely do. And so you have to build a product that can be resilient through the stuff that on paper shouldn't happen, but it certainly does anyway.
So with that being said, Cy, how have you found, you coming from this engineering background, how has that helped you kind of maybe see things that others don't see, who have maybe been entrenched in the industry for years, decades at this point?
It's one of those things where I didn't really understand. I had a gut feeling kind of coming into a new industry that coming in with fresh eyes would be a benefit. I didn't realize how big of an impact it would make. Because when you come in from a question of just true curiosity and you just ask the questions that others sort of take for gospel because they've been in the industry for 20 years or 30 years, you realize the why behind why the way things are maybe isn't for the reasons that you think. And you can actually accomplish things that others just didn't ask the questions that would have allowed them to do so. So for us, we've come in and we've knocked on the doors and broken down some walls because we ask a lot of questions from that perspective. And it's been phenomenal and also slightly nerve-wracking because you expect the authorities to have the answers and sometimes they don't. So you realize when you can really dig into these problems what sort of creativity and solutions that you can actually deliver, and it's happened for us time and time again. Just like our processes, for example, like why do you distribute on certain days and what's this? It's ultimately one of those things where we just ask the question and now we've actually found more effective ways to deliver value for investors through that lens. So I think that's been one of the biggest learnings, to never be shy, to come in and just ask the why, because it can surprise you what some of the answers you're going to get.
Yeah, and over the past year, what kind of feedback have you been hearing from investors about TSPY? You know, obviously America first because it's listed on American exchanges. So maybe touch on that, and maybe touch on if you've actually heard from Canadians.
Yeah, I've had both sort of inbounds and people that are using it, and I think the most energizing piece is just to hear people say, hey, like, I know this is early in your growth trajectory, you're just starting as an ETF issuer, but because of, and they'll share the transparency that you have, and sort of like you, with the help of conversations like this, are able to help people look under the hood, and that gives people comfort. Transparency equals trust, and I've had a few inbounds that honestly, like, I'll never forget about, where they say, I see how you're managing my assets and resources and I trust you to do so. That for me is a game changer, because that means a lot to us. And so that's one of the things that we went out knowing that one of the things we wanted to disrupt in the finance industry was education and transparency. And we're going to continue to do that in lots of ways, but the first place to start is the product sets that we offer. And so, like, we're an open book for how we manage, why we manage the things we do, and creating that interaction with investors has really built a significant amount of trust, which honestly for us is the thing that is the most energizing and gets us out of bed. There's lots of ways to spend your time. There's lots of different ways to sort of make a living, but when you can actually couple that by creating real impact in people's lives, and you hear about it, it's one of the most humbling and phenomenal feelings that you can have professionally, that I'm really, really happy about.
It should be on the ETF issuer to get in front of a lot of this stuff. Don't be shy to get on camera or with people like myself and just have a chat about the various products. I think it's a symbiotic relationship. For the ETF issuer, you're leveraging a platform like YouTube and the creators who really like to talk about it like it's a fandom, and people really latch on to that. They latch on to the personal stories of the creator who are using these products for their own hopes and their dreams. And I think that speaks so much deeper than any kind of billboard advertisement. That has its place, but there's this other deeper, I think, level where I think when ETF issuers partner up with the creators, they can work together in a really powerful way. Not just like, and every once in a while I'll see comments about right? YouTubers working with ETF issuers, they're in their pockets. They're just gonna hammer on their talking points. But I gotta say, in my experience, there's a lot of freedom in what I have to talk about. Yes, between regulations and the various laws on the books, yes, there's certain things we can't talk about. A good example of that would be forward-looking yield. If anyone's wondering, if you're newer and you're like, why aren't they talking about TSPYs? Maybe, what will the yield look like 1 year out? Well, that's like something we can't talk about because we can't guarantee what the distribution is going to be next month or 6 months from now. So there's a lot of stuff behind the scenes that if you're wondering like why certain things aren't getting touched on, at least throw it in the comments. I can probably reach out, answer to you, or you never know, the ETF issuer could reach out as well in the comment section below.
To your point though, the creators that I think we connect most with are the ones that also really, really are educators in the nature of the content that's put out. And the challenge with finance is it's complex. And a lot of stuff can be hiding under the surface when you call something a yield versus if you call it a distribution, and understanding what all the metrics and everything mean. But the thing that is most encouraging is, number one, how investors are looking to get educated, and they are smart and they are soaking up the information, and creators like yourself are putting out content that just is trying to create a look under the hood that really helps people make decisions for what's going to be best for their lives. And that combination, I think that's the place where you can really find strong collaboration, because everybody who is trying to do right by just financial education is going to subscribe to that same philosophy. And I think I found that on your channel. That's why I really appreciated investors that reach out to you and are engaging in conversations and are asking those questions, because they truly want to get educated on what's going on under the hood, because it makes a huge impact to the outcomes that they can try and deliver for their lives and their families.
Perfect. And I know we just touched on yields, and TSPY has kind of hovered in this, depending on market conditions, it's kind of hovered within this sometimes 12 to 14% yield range. I think last time I looked, it might have been slightly over 14%. Now that it's kind of found this narrow band of yield that it seems to be sitting in, and its performance as well has been tracking so close to the S&P 500. Can you maybe just talk about maybe some of the dynamics between growth and income together versus maybe a total return where you're seeing more of it through the distribution itself? And like, what are some of the long-term consequences if you're only relying on the distribution for the majority of your total return?
It's one of those things where it completely depends on your goals as an investor. And so when we were trying to decide what the distribution should be, we initially had a conversation with a creator, my first convo doing a YouTube interview, and we're so excited because we're going to try and track the S&P 500, and we're shooting for a 7 to 8% distribution. And we got laughed out of the studio, kind of thing, where all of the viewers were like, well, that's not very exciting. And I'm like, what do you mean? I was so excited to be able to deliver that. And then we saw the other end of the spectrum where some ETF issuers were pumping out 25, 30%. But I'm like, where is that coming from? That didn't feel right either. And so we ended up actually landing kind of in the middle at 14%. And I think the real kicker is why 14% was a good balance. There's two audiences that we're trying to serve in this product set. One is the individual DIY investor that needs, meaningful income to sort of plan and live their life off of. And then the other is advisors who are managing resources for their clients. Advisors tend to want to minimize distributions if they're looking for a core equity product, whereas some of the retail folks are looking for higher distribution numbers, despite that, in my opinion, being the wrong metric to really focus on. Total returns is really the name of the game. So we found a way in the middle where the advisors were distributing it as tax efficiently as possible. So we're hoping that, if 2025 is similar to 2024, when distributions come out, if you don't need it, we're doing it as kind of constructive return of capital, which means that there's not a tax loss you can pump it right back in without actually taking a tax hit. So it's efficient in that way. Knock on wood, that's the goal. And so that checks the box for the advisors who want lower distributions. But then if you actually do need the capital, we're able to distribute it out in a tax efficient way. So it's not what you earn, it's what you keep. And from a tax efficient distribution standpoint, we can help people reach those goals too. So that was sort of our 1-2 of saying, okay, this is the right number. Around 14% feels right. Market's been delivering more than that in total returns over the last several years. So let's see what happens. But again, you can't guarantee what distributions are in the future. It depends on what the markets will do. We've been successful in our first year, and fingers crossed we'll continue to be able to deliver for folks in our second.
I just had a thought right now. If you are going for a blend of income and growth, I suppose that if there is that internal growth, can you not use that as part of the return for paying out distributions? Can you sell off a part if you need to?
You can if you need to. And so that's one of the things where if you think about markets doing this as they've done, but if distributions are steady, the contributors to that distribution number can come from different components of the fund. So like if markets are down, well, guess what? Option premiums are probably up because the VIX is up. You can stack a whole lot more of option premium into your distribution. But the opposite is sometimes true when the markets are way, way up and you're having a hard time staying ahead of the market with your option premiums. Sometimes you can actually fill in the consistency from different components of your portfolio. So it creates that balance from the different buckets in order to sort of help ETF issuers deliver consistent distributions in a way that is very, very different than if you're just looking at pure market performance when they're doing things like that.
I got another question for him. This is, I know the audience, especially in Canada, honestly, I'll speak for...
Speaking for Canada?
Speaking for Canada, I do feel as if, like, the Canadian marketplace for, I know it's biased. I live in Vancouver, so I get it. For any Americans watching this, I got a lot of American family, tons of American family, that we have these really great products. And sometimes I kind of find myself knocking my head against a door and thinking, like, there are so many great products up in Canada, and how come there aren't fund managers that are taking advantage of some of the structures that we see in Canada? 25% long leverage or classic leverage, as most of the audience from Canada is aware of. And then, of course, there's the talk of course, stable distributions as well. We're hearing this in America. You see a lot more run and gun variability in the distribution payouts. That's obviously not the case. That's not the case for TSPY. But how come 25% leverage doesn't seem to be a thing down here, or at least not yet?
I think it's coming.
Okay.
I think it's coming. I think it's one of those things where if you think about the why behind it, and the Canadian markets are taking advantage of it, it sort of helps bridge the gap for some covered call strategies to keep up with the underlying security if it's a diverse index and you believe over the long term that things will go up over the next 10, 20 years. It makes a ton of sense. There is risk, of course, with it, because if things go down, you're going to get hurt more than the underlying security if you just own that. But the idea actually makes a lot of sense, especially when you're looking for higher growth potential and higher distribution. So I think it's an idea worth exploring, and it's one of those things too. You've got to have the right partners to do it. We've, it's one of those things. I'll leave it at that. But I think there is merit in the idea, and it would be great to see that part of the American market grow.
When you think of that 25% leverage, you can write on it, or you could just leave it uncapped, unbound, let it rip if the market's ripping. Who knows, right? So it's as always, it's at the ETF issuers' discrepancy to do so. I think a lot of the feedback and the audience will kind of appreciate that, your thoughts on the leverage. And then I would say the next component that I think that is especially here in the States versus Canada is a lot of ETF issuers in Canada, they do portfolio coverage on, say, half the portfolio, incorporate that 25% leverage, and then they leave that other half uncapped so that it can participate in growth. And a lot of the times we're also seeing 13, 14, 15% yields, trying to match the index, whether it be the NASDAQ 100, the S&P 500, the Russell. Not too much Dow Jones. I think we got one, but it's not really, it's under that 10% yield. You guys know I talk about 10% plus. That's what this audience is interested in. Mm-hmm. So the counterpart or the countervailing factor to that is we notice that in the States here, everybody seems to write on 100%. Can you maybe speak to that a little bit? As how come nobody seems to do that half measure?
I think there's some that are starting to. I know Goldman has a product that does some of that, and the engineer in me sees it as essentially trying to get to the same goal with two variables instead of one. So there's two variables that as a fund manager you can kind of pull to figure out the balance between total return and income generation. Variable one is how far out of the money you are. Variable two is what percentage of your portfolio you're covering. So in my first swing, we wanted to minimize variables and actually optimize for moneyness. So we ride up to 100%, but we have a dynamic mechanism to help sort of manage the risk with the one variable. We've run some of the numbers to say, okay, what if we did, 50% coverage and then also had that second moneyness? And the one drawback is you just don't have as many money soldiers working for you on the option side versus the the growth side. And so if you believe that your covered call strategy will not be able to keep up with the underlying on its face, that's a better way to go. We don't feel that way. We feel like we can keep up with the S&P, knock on wood, can't guarantee it, and in some environments potentially outperform. And if you look at since the April recovery in the US market, April 11th through today, you can see what the 100% notional performance can be with one variable. And that's what we built. That seems to be working, but there is absolutely merit. On the other side, I just think I want to try and get all the soldiers working to help provide returns for investors versus betting that maybe I won't do it right and we won't be able to keep up with the underlying.
I see. Let's talk about TSPY's AUM. You've been on my channel, you've been on other channels, and you have said that once TSPY reaches $50 million in AUM, something else is coming. Can you speak to that?
One thing I've got to start with is a huge thank you to all of the retail investors, DIY investors, to creators like you that have kind of cracked open the hood and actually gotten TSPY to that level and through it. So as of less than a year of TSPY being on the market, we crossed the $50 million AUM number, which for a first-time issuer, first-time fund, no institutional seed capital, nobody's saying, oh, I'm going to move it from bank account, like my institution's account. We started from $0 and got to 50 and now actually are currently at just over 66 million in AUM for TSPY. So as soon as we hit that marker, we've announced we're launching our second ETF, which is TDAQ, the same strategy, same fintech infrastructure, and the same trading philosophy, but on the Qs, on the NASDAQ 100. And that is going to be, I think, a really nice complement. You can choose which index you love the most, or some people are going to have both. But the cool thing about the NASDAQ 100 is that it has some other characteristics to it. One of them is the volatility is a little bit more. And so when the implied volatility is a little bit more, there's more option premium to go harvest. So there's some complementary characteristics, and we are so excited that we can actually take the patterns we've seen, the technology we built, the trading philosophy and processes, and take everything we've learned with TSPY and on day one apply it to TDAQ 2. So that is getting launched September 4th on SIBO. So keep your eyes peeled, and that's coming soon.
You hear that, investors? TDAQ is coming soon, especially if you are a fan of Katara and the story of TappAlpha. I want to just reiterate, just how unique a story like size is to this industry. For those who maybe are not as familiar with AUMs, maybe they only think I'll only invest in funds that are above $1 billion in AUM. I think you just need to look under the hood and who's running it, because you might end up with a fund from for lack of a better term, a dinosaur fund manager with a dinosaur infrastructure. SPY here is clearly at the forefront. of, like I said at the top of the video, with a scrappy entrepreneurial mindset to get these really innovative products that might be really difficult to get going. But I think when people hear and see what you're doing, it is a remarkable story, and I want to emphasize that. I think people, no matter what investor you are, you're drawn to stories, especially inspiring stories like we have here with Cy. And so Cy, your team's going to be obviously very busy with TDAQ and continuing the success with TSPY. Investors might be wondering, and I'm sure, if I don't ask this question, it'll be in the comment section. Well, okay, TSPY got to 50 million, and then TappAlpha launches TDAQ. Once TDAQ reaches 50 million, are there other products kind of in the lineup that you're thinking of? Like, might there be a Russell or a Dow Jones, or maybe some other specific product that you guys want to launch?
Absolutely. I think that's the most exciting part about reaching our 1 year anniversary for TSPY. The whole goal for us was to say, hey, we believe we can do this. We can launch something that is going to perform in the way it was designed to perform. And looking at the first year, it was a challenging market. I mean, one of the toughest in recent memory with the volatility that we've had. And TSPY's philosophy, the execution, the tools we have, you can see how it stood against the competing funds and against the market itself. So we're really proud of, I think, what we started and what we built and the why behind why we did it. And now, year 2, I think the common motif is going to be the theme. How do we take what we've built, what we learn, and how do we scale it? Because our ultimate goal is we want to impact as many people's lives as we can to provide these powerful solutions to people that otherwise wouldn't necessarily have access to them. And that's the driver for us. So the short answer is yes. And the exciting part is there's a couple that are sort of already in the hopper that take some ideas that we've learned over the first year, put them together in new products to help solve some additional problems that we've heard from the retail DIY community, from advisors as well. And there's ways to scale out the things that we built even in other ways. So we can't wait to get TDAQ out. And then, since year 1, we've sort of proven some of the core foundation of what we have to offer. We can take that and now find ways to apply it to solve other problems for the industry. And we're in a great spot to continue to sprint and deliver that for investors.
Yeah, I'm excited for you guys for that, and who knows, maybe you get some scenic backgrounds for other future interviews with other products that Cy and his team are going to be launching. So I think from that standpoint, congratulations on the success of TSPY, the soon to be launched TDAQ, other future launches. I'll be watching you guys very closely because I'm a big fan of stories, and I think this is a really good story playing out, everybody, in front of us. And I can't think of another one quite like it. So just once again, thanks, Cy, for having me down here on your beautiful boat and doing this interview here. And I know my family has really enjoyed spending the Labor Day long weekend in Seattle. So thank you so much for that.
It's great to see you down here. Really appreciate the time and taking the effort. And I was thinking back to, I think the first conversation we had, I don't remember what our AUM was at that point. I think it was somewhere in the $10 to $15 million range. Yeah, now we're pushing 66. So I appreciate your vision to be able to see that there's potential here, and being sort of an early person that wanted to have a conversation, and I've just really appreciated it.
Yeah, and I think to that point, I mean, if some of you have the cover call ETF ALLSTAR tracker, what's a video of mine without mentioning that? But in the AUM tab, I track AUM month over month. So if you have the tracker, go to TSPY and see what the AUM, how it's grown month over month, to get to that $50 million range, because I want to say it kind of hovered in the teens for a while. Once it kind of got past 25 million, it seemed to just like the momentum started to really chug along for it. The last I remember looking at it. Well, with that said, everybody, check out the Cover Call ETF ALLSTAR tracker for all the info on TSPY and TappAlpha in general. I'll be adding TDAQ to the tracker, that's for sure. So once again, you know what? Check out TappAlpha, their website. contact side, there's a comment section in there where you can send them a message and just reach out. And if you got anything to plug, go ahead.
I think, ultimately, just really appreciate you taking the time. Love the questions that come in, so please leave comments or shoot messages to us through TappAlphaFunds.com. And then one question I'll put out to folks, and I'm really curious to hear your answers. We haven't committed to a target distribution rate for TDAQ yet, but I'm very curious to hear what the DIY investors and retail community are preferring or what they're expecting, just as an input for us. We're going to let the data kind of speak for itself, but I really want to know, does the market and the data, do they match, or are there ways to just sort of tailor and make the product fit what the industry is looking for? So please, I love comments and messages. Send them our way, and looking forward to staying in touch.
Well, there you have it. What other fund manager out there is asking for your specific input just like that? So once again, Sai, thank you. Take care, everyone. Hit all the buttons of the like and subscribe variety. We'll see you all in the next video.